Hello everyone, welcome to another edition of Under the Macroscope, Skybound Capital's weekly podcast, and sadly, for some I hope, the last one of 2021. A pleasure to welcome to the podcast today Chief Investment Officer for Skybound Capital, Theodore Xu, sitting in the Hong Kong office, and Chief Strategist for the group, Jabir Sadawala, in the London office. And today, in the last podcast of the year, we're going to be focusing in on an asset class which really has become synonymous in many ways with Skybound Capital's offering, and that is the area of private debt, also termed private credit, and in particular, one of Skybound Capital's funds, the flagship fund, the Prism Income Fund, which has been running in this space for over 12 years. So, gentlemen, in the context of low interest rates globally and the risk of inflation, which are two topics that have been prominent in our podcast series throughout the year, how have investors had to retailer their portfolios? Jabir, perhaps I can start with you.
Yeah, hi, good morning, Matt. I think actually a lot of investors haven't fully understood or appreciated the need to do so. Now, in the past, as you quite rightly said, we've spoken about inflation. When we had our last webinar, back then, inflation hadn't come to the fore. So the focus then was very much on yield because it's part of a growing demographic trend. The added complication now is that inflation has come back with some force. I mean, if you look at the rates around the world and the concerns around it, they are very significant. So as a result, you have people who are sitting with their money in bank accounts, thinking that it's safe and protected. It's not. They are losing real wealth in real terms. I just don't think they fully appreciated it, or they think it's only a temporary phenomenon. Also, if this theme of inflation persists, then they've got to take that into account for their portfolios going forward. Otherwise, they're still going to be losing money in real terms.
So the investment landscape really has changed. And as Jabir has said, people have had to remodel their portfolios in order to try and make up some of the lost ground. And private debt is proving to be an asset class that can do that. But Theo, for those of us who have worked in and around the space for quite some time, we throw the term around quite loosely. But perhaps to get back to basics, what exactly is private debt?
Sure. When I borrowed 10 grand US dollar from my mom for the down payment of my first property, that was a private debt transaction, and I paid interest. Private debt was always existing, by the way, in different shapes and forms. Of course, today we are talking more about private debt as an asset class. I suspect different investors will have their own definition. In the past, when a company needed debt funding, it usually went to get a bank loan or issue bonds. Such bonds were normally listed somewhere with all information public. With the tightening banking regulation in recent decades, many private companies no longer have access to either. Now, many asset managers, large family offices, large institutional investors are willing to offer direct lending to such companies. They negotiate the terms and covenants and agree on a private debt deal. Such deals were ballooning as a result of the economic recovery after global financial crisis and the burgeoning private equity market. I also want to clarify a commonly seen misconception that people associate private debt with high risk or bad credit quality. Similar to public bonds, where you have investment grade, high yield, and a variety of credit ratings, there is also a wide credit spectrum within private credit and private debt too.
So, Jabir, picking up on what Theo has said around what exactly constitutes private debt and taking into account the macroeconomic factors that you started with, why has private credit, private debt been such a prominent asset class of late?
It's certainly growing, and I think the reason it's growing and becoming so prominent is this pursuit for alternative assets that can defend somebody against the background of inflation. That's the critical component. And if you look at what private debt can do here, it comes in all shapes and forms. The key component to it is maturity. You can have the shortest maturities right up to the very longest maturities. But within that, the ability to reset your interest rates is critical. So at the very shortest end, what you have in these ultra short duration bond funds is something, a component, typically 30, 40%, that is maturing even as quickly as every 3 months. And with that money, they then have to go out and buy in the market. At the very long end, and depending on how these rates are set, they might not have the same degree of flexibility. So what we're trying to do here is to find that balance between the right investment deals and the ability to reset those loans in order to deal with the problem of inflation. I think that's one of the critical factors and one of the reasons why it's growing. If you look at some of the data through Preqin, as an example, this asset class this year is probably going to hit around $1 trillion, just that whole private debt space. And it's projected to grow to over 1.5 trillion, in another 4 or 5 years from now. So I think the very fact that those growth rates are so significant tells you that more and more people are turning to it. If I can just add one more thing, Theo alluded to the potential risks associated with this. After all, it's a credit play. The rather unique thing about private debt is that it can be tailored to the company's needs. This is why it particularly favors SMEs, small to medium-sized enterprises, and you can secure it with assets. And in the process, you can change your risk-return profile and improve it.
So I'm going to come back to you a little later, Jabir, on precisely that, risk management. Before we do that, though, Theo, Jabir's talked about an asset class that's on a trajectory towards $1.5 trillion, which is more than significant. So drilling down a little more closely, how does the Prism Fund fulfill demand within the asset class?
I think Jabir has already touched on a key point, SME, and I'll circle back to this very quickly. We stumbled on this opportunity to launch a private credit fund more than 12 years ago, and very quickly we realized that it could be institutionalized. And that's exactly what others are seeing too. Hence the 12 trillion opportunity set that we're seeing today. Over the years, we had the luxury to dynamically deploy our capital across geographic regions and sectors. More importantly, we built up a great team with solid expertise and network, which is imperative in deal sourcing. Now, private debt has grown to a very large asset class on its own, and investors are amazed at the dry powder asset managers have amassed to allocate to private debt transactions. And that's, again, the 12 trillion we talked about. However, seemingly there's no lack of capital. There remains a big mismatch in the tickets large managers can write and the tremendous number of small companies hungry for capital. So outside of the KKR and Blackstone of the world, the Prism Income Fund actually benefits from its own size, which is not too large, not too small either. That allows us to be nimble and look at opportunities others miss or overlook. Look at opportunities, particularly in the SME space, be it direct lending to the small and medium-sized enterprises or direct lending to the non-bank lenders who service either individuals or SMEs. For this fund, there is a natural element of impact investing. Over the years, we have funded small quality businesses that have grown, serviced more clients, hired more people, and contributed more to their societies. And I believe that is the value proposition of Prism Income Fund.
Jabir, the fund's got an enviable track record over more than 12 years. And just coming back to assessment of risk, it speaks, the track record, more than anything, to robust assessment and management of that risk. So perhaps a word on just how you and the rest of the team have been able to achieve that.
Yeah, happily. I mean, it's there are really two elements of risk here. One is obviously around the security, the protection we strive for when we go into individual deals and lend to them to advance their businesses. The other is around the opportunity cost, because that's important too. So if I can deal with one issue first, and that is the Prism Fund, since its inception, has been annualizing at pretty much 8%. If you take into account 10-year US bond yields, and in addition, where inflation is today, even factoring both of those components in, we're still generating a return over and above the combined effects of inflation, which, roughly speaking, is at about 5%, depending on which measure you take. Some will say a little bit higher, and then the Fed's preferred rate is a little bit lower, plus the US 10-year, which, give or take again, has lately averaged around 1.5%. Put the two together, Prism has still outshone both of those. So we're giving investors well above what those two components put together are generating. In other respects, we don't take on any leverage in the fund. This is an unlevered fund. So to be delivering 8% per annum is really quite something. On top of that, the different currency classes that we offer are hedged. They're fully hedged. So that takes away the need for an investor to undergo any FX hedging. Plus, if you look at the volatility, there's no mystique. I think often people look at the return profile and they see a straight line and possibly they panic. I understand that, especially given past events, but there shouldn't be any concern. This is a debt strategy. What does that mean? It means we lend, we collect our interest payments, minus any defaults, which to date, thankfully, have been zero. And then after various fees for operations and so on, that's what we give the investor. That's all it is. That's the reason for the straight line. And if we continue to do our jobs the way we do, that's what we should continue doing.
So the track record is robust, it's consistent, but to be clear and objective here, Theo, the asset class is not for everyone, especially if you want favorable liquidity terms, right?
Well, you talked about earning back the lost grounds at the beginning, and I think we are really here to help. We would love to help everyone. However, you're right. I don't think this asset class is for everyone. We come across a lot of inquiries often. For example, can we use Prism as a substitute for money market funds? Can we use that to replace a high yield bond portfolio? The quick answer is no. No to either of those questions. And frankly, I think private credit is very well received among institutional investors nowadays. Large asset allocators always have a big silo in their portfolio set aside for private debt. But that is on condition of 2 points. Number one, these are people who are familiar and knowledgeable of private debt. I'm not saying they know how to do each transaction, but at least they are familiar with this asset class. They've done their homework. And we encourage so for all investors who are interested in this asset class. And number two, these are investors who are well aware of the liquidity requirements of the underlying assets. Okay, there are two big schools of funds out there in private debt. Some of them offer a closed-end structure with 5-year, 7-year lockup. Some of them offer an open-end structure like our Prism Income Fund. But regardless of which type, you need to appreciate that the underlying loans have a maturity. And there are very little opportunity that you can somehow shorten that maturity and get your money back tomorrow. And therefore, for investors who are only attracted by the decent return this asset class has generated over the years, they should really look at the underlyings and what comprised of these funds. Therefore, I think back to your question, this asset class really is for sophisticated investors who have some knowledge of private credit and also appreciates all the features and characteristics of this asset class.
Yeah, and a key component is having fund managers, asset managers who are willing to share that knowledge. It's been fascinating watching the space and the asset class grow. Fair to say that Skybound Capital was one of the first into the space, and with that 12-year track record, it's heartening to see the growth in interest in the space, and particularly given the macroeconomic conditions globally that we've spoken about during the course of the year. Theo, Jabir, as always, it's been fascinating throughout the podcast series this year to gain your insights and to be the beneficiaries of all the research that you do. So thank you for that, and specifically for your input into today's podcast. Remember that you can download the Under the Macroscope podcast on Apple, Spotify, and the Google podcast platform for Android. And all editions of Under the Macroscope from throughout 2021 are available at our website at www.skyboundcapital.com. So we're going to be taking a break from the podcast for the remainder of this year, and we do look forward to catching up during the course of 2022. And thank you for your support and your feedback for the podcast during 2021. Until next time on Under the Macroscope, have a good break, and we look forward to being in touch again next year.